Today on Ag News Daily.
The market's almost kind of priced in a complete lack of China demand, or at the very most absolute minimum China demand, which in my calculations is we could get away with China really only looking to import 9 to 10 million metric tons of beans, which is substantially lower than a year ago.
Welcome back to our weekly edition of the Ag News Daily Show. We're in here before going to the field. You don't look like
I'm not going to the field.
You don't look like you're going to the field.
It's been too wet to go to the field, really.
It really has. We've got to switch over to corn. Not quite done with our beans, and excited to get out there. It looks like, despite some of the rain, there is drought that continues to impact much of the U.S. Nearly 73% of the contiguous states are experiencing some level of drought. The Mississippi River at the Memphis measurement is running just over 4.5 feet below earlier this week. Forecast models suggest that over the next 30 days, the south from Texas through the Delta into the southeast is likely to remain drier than average, while the west central area, the northern plains, the west Great Lakes, and the Midwest, as well as the northeast, could see a return to typical fall weather volatility. Warm temperatures across the South and Midwest, combined with the moisture pulled from north of the Gulf, could create a destabilized region across the Delta, the Mid-South, and the Midwest, potentially triggering thunderstorms. This system may be the first in a series of one system forming roughly once a week, delaying for the rest of the fall. Harvest conditions are mixed. A stalled front in the Midwest brought showers earlier this week that we were just talking about. Another system pushing eastward over the weekend. While we will see some areas in the Northeast will get the delayed harvest conditions, most regions should be able to experience good weather for fieldwork. Here in the central and southern plains, periods of rain may slow down harvest in certain areas, though soil moisture remains mostly favorable for winter wheat establishment, with only limited areas expected to see beneficial rainfall. They might have to re-listen to that a couple of times with the regions and keep them all straight, Delaney.
A lot of different weather patterns going on this week. Well, of course, there is no crop progress update this week due to the continued government shutdown. So let's highlight what some of the farm groups are asking for from Congress now while we have this pause. Both the American Farm Bureau Federation and the National Farmers Union have sent letters to President Trump and the administration, as well as congressional leaders, warning about worsening financial conditions in rural America. The AFBF highlighted severe economic pressures on farmers and ranchers due to failing crop prices, rising input costs, and ongoing trade tensions. The group noted that since 2022, crop prices have fallen off a cliff. That's a direct quote. And the U.S. agricultural sector has shifted into a trade deficit for the first time in many years. While AFBF acknowledged the emergency aid could offer some short-term relief, noting some of that market facilitation payment-esque type of relief, they did urge leaders to focus on long-term solutions, including fair trade agreement, stronger biofuel policies, expanded milk options in schools, and to look into high agricultural input costs. NFU echoed those concerns, calling for immediate economic relief for family farmers, while also tackling corporate consolidation in the agricultural industry as well. NFU President Rob LaRue emphasized that meaningful aid should prioritize family farms, balance assistance across regions and commodities, and be tied to reforms that strengthen fair competition, as well as expand domestic markets for U.S. crops. Although President Trump has said his administration plans to offer financial support, possibly through tariff revenues or the USDA's Commodity Credit Corporation, or CCC fund, the ongoing shutdown, of course, has delayed any potential payments indefinitely, Tanner.
Yeah, quite an interesting period of time as we have these delayed report releases. Speaking of China, though, Treasury Secretary Scott Bessent, he confirmed that Wednesday there was a long-anticipated meeting between President Trump and Chinese President Xi. The meeting is now back on, which is raising hopes for progress on the stalled U.S. soybean exports. Speaking with Fox Business, the Treasury Secretary said that the two leaders will meet next month at the Asia-Pacific Economic Cooperation Summit, which is hosted in South Korea, despite recent tensions between Washington and Beijing. This announcement follows President Trump's threat to impose a 100% tariff on Chinese goods by November 1st in response to Beijing's new export controls on rare earth minerals that were critical to the U.S. manufacturing and defense industries. President Trump says that he plans to raise China's effective ban on U.S. soybeans during these talks, adding, "He's got things he wants to discuss with me, and I've got things I want to be discussing with him, and one of those is U.S. soybeans." Soybean futures edged higher Monday on the news that Trump and Xi would be meeting, and that meeting would be back on as traders bet the talks could help ease export restrictions. Farm groups and analysts say any progress on the agricultural trade could have an immediate impact on commodity markets and farmer sentiment as we head into the last parts of harvest. Treasury Secretary also said that he's optimistic that this dispute could be de-escalated before the summit, though he noted that all options remain on the table regarding tariffs if China continues to restrict exports of critical minerals to the U.S. So I did see those headlines back and forth this week. Quite a roller coaster for some of our farmer listeners.
Yeah, I think there are some fresh headlines as of maybe last night as well. So certainly not an easy path forward. But the Association of Equipment Manufacturers this week reported that on Monday, the U.S. tractor sales showed signs of recovery in September, rising 4% compared to a year ago, the first monthly increase of 2025. Dealers sold just over 17,700 tractors, up from 17,000 tractors in September of 2024. The strongest growth came from mid-sized models between 40 and 100 horsepower, which were up 17%, while smaller models under 40 horsepower climbed 3%. The growth was also offset by sharp declines in larger high horsepower and four-wheel drive tractors, while combine sales also fell 22% for the month. Despite September's improvement, year-to-date tractor sales remain down 8% compared to 2024. Larger tractors above 100 horsepower are down 25% so far this year, and four-wheel drive tractor sales have dropped nearly 40%. Combine sales are also lagging, totaling just over 2,600 through September, 40% below last year's pace. Canadian equipment sales were more upbeat, however, with tractor sales up 7% and combine sales surging 42% from last year. AEM Senior Vice President Kurt Blade said the modest U.S. increase is encouraging after months of decline, adding that the improvement reflects the industry's resilience and continued demand for agricultural equipment heading into peak harvest season.
The combine numbers are not surprising.
No.
Feels like a lot of our listeners have had several dealerships asking them to buy combines. Is that inventory?
The time for that one.
Well, our specialty crop farmers and listeners across the U.S. are facing mounting financial pressure in 2025 as production costs continue to rise faster than their prices. Once stable markets for fruits, vegetables, nuts, and other high-value crops have become volatile and are now squeezed by the same trade uncertainty, labor shortages, and high input costs. Specialty crops, a diverse group of more than 350 commodities worth over $75 billion annually, now account for more than a third of all U.S. crop sales, yet growers are having far fewer risk management tools available or safety net programs to cushion their losses. Producers of almonds, walnuts, apples, and strawberries are reporting steep declines in profitability. In California, the almond returns have fallen more than 35% since 2019, pushing many orchards into the red. Apple and strawberry growers are also seeing losses that stretch into the thousands of dollars per acre as labor and regulatory expenses are surging. Even as some of these prices have begun to tick higher, they haven't kept up with the pace of those rising costs of fertilizer, fuel, and wages, many of which are up 30 to 50% in the past years. Industry groups have said that this gap between the cost and coverage is widening. Nearly half of U.S. fruit, vegetable, and nut acreage remains uninsured under federal crop insurance or disaster programs. This leaves many of those producers exposed when weather, market, or pest disasters strike. Farm policy experts are warning without stronger risk management tools available, expanded disaster aid, and better data for the specialty crops, more growers may be forced to scale back or exit the industry altogether. This would threaten the diversity and stability of our nation's food supply. So a lot of similar row crop issues extended into our listener group there as well.
And we're going to talk about a fertilizer update here later in the show. But staying on the specialty crop note, let's have a fun piece of news. Tanner, does your family carve pumpkins for Halloween?
Our neighborhood typically does get together and all carve a pumpkin.
Well, as Halloween approaches, millions of Americans are on the hunt for the perfect pumpkin. And chances are it came from Illinois. The state harvests more than twice as many pumpkin acres as the next 5 states combined, producing over 634 million pounds of pumpkins in 2022. The next closest state, Indiana, grew just over 161 million pounds with roughly 17,000 acres in production. Illinois is also home to the 2 nation's largest pumpkin processing plants. The University of Illinois Extension commercial agricultural educator Nathan Johanning says Illinois dominates the pumpkin world from carving to canning thanks to its location and ideal growing conditions. Johanning said this region developed into pumpkin production because we have fairly ideal conditions. We have a balance of summertime heat, very fertile soils, some of the most productive in the world, and a temperate climate that makes pumpkins appreciate and enjoy. Johanning also says that much of Illinois' pumpkin crop, especially processed pumpkins, ships far beyond state lines. So chances are you've probably had an Illinois pumpkin, Tanner.
We got off the beaten path on the way to Farm Progress Show this year and drove right through the heart of pumpkin country.
Oh, very neat.
It was a sight to see.
Well, Tyson Foods and Cargill have agreed to pay a combined $87.5 million to settle claims they conspired to fix beef prices. This settlement, filed this week in Minnesota federal court, resolves allegations from 2019 class action lawsuits brought by consumers who said the companies worked together to limit cattle supplies and inflate beef prices. Tyson will pay $55 million and Cargill will pay $32.5 million as part of that joint agreement. The settlement applies to consumers in 26 U.S. states and Washington, D.C., who purchase beef from major retailers like Walmart, Costco, and Sam's Club between August of 2014 and December of 2019. Both companies deny any wrongdoing, but have agreed to cooperate in the ongoing case against the 2 remaining defendants, JBS USA and National Beef Packing, who, along with Tyson and Cargill, control roughly 80% of the U.S. beef market. Reuters reports that there could be as many as 36 million eligible class members affected by the alleged price-fixing scheme. The settlement, which still needs a federal judge's approval, comes after Cargill earlier this year agreed to pay millions in separate lawsuits over turkey price-fixing. So,
well, look at us here as we have great transitions from turkeys to turkeys. Thanksgiving will be approaching soon, and turkey once again is taking the center stage. But this year's holiday bird comes with a new challenge for producers: the highly pathogenic avian influenza that we've reported on multiple times. It's reemerging now in the upper Midwest after a quiet summer. It is affecting about 18.7 million turkeys since 2022, including 2.2 million so far in 25. Cases are climbing, with wild bird migration picking up. Experts warn additional detections are likely to come over the next few weeks. As a result, U.S. turkey production remains historically low. The latest USDA report, released in September, estimates 195 million turkeys were raised in 2025. That would be a 3% decrease from last year and the lowest in 4 decades. USDA projects total turkey production at 4.84 billion pounds this year, about 11% lower than 2023. Fewer birds will mean higher prices. The average wholesale price of frozen whole turkey is expected to reach $1.32 a pound, which would be 40% higher than 2024. But despite the disease pressures and tighter supplies, shoppers still find plenty of turkey for their holiday tables this year, though many people may pay a bit more at checkout. According to the American Farm Bureau Federation, they will release their annual turkey dinner cost survey on November 19th, giving consumers a snapshot of what they expect as they prepare for their holiday season.
Yeah, I'm just trying to think of, is it worth the extra cost to eat turkey on Thanksgiving?
Have to, it's tradition. Well, before we get to Angie, let's take a quick look at what's going on in the fertilizer markets first. Global fertilizer markets remain tight and uncertain, according to Josh Linville at StoneX. Urea prices are hinging on China's export policy after October 15th. A halt could steady prices, while continued exports may add pressure. India's latest tender could also influence supply throughout the end of the year. UAN and ammonia supplies are tight, and U.S. sanctions on Russian exports, plant downtime, low inventories, strong fall ammonia demand is keeping these prices supported. Phosphate prices stay high with limited Chinese exports and import barriers, while potash remains steady, but demand is uncertain as we head into the rest of this fall. So, Delaney, I'm glad that you had to have that conversation with Angie while we were out in the field. Why don't you introduce us to what you talked about?
We covered a lot of different topics. We primarily focused, of course, on grains, as that is Angie's bread and butter. She's at Goddess of Grain on X. So let's turn over to that conversation with Angie now. Well, folks, we are excited this week to have on Angie Setzer with Consus Consulting at Goddess of Grain on X. Of course, Angie, it's been a little while since we've had you on. Thanks for joining us.
Yeah, thanks for having me. It's hard to believe how quick time goes anymore.
It is. So, Angie, would love to get your take on the markets. I know you and Carl put out a daily newsletter and you keep folks in tune. You look at a lot at cash and basis, which is something I want to get off to here in just a little bit. But let's start out first with macro level grain markets. What's going on? What are you watching this week?
It might be a shorter list to tell you what I'm not watching this week, it feels like. But yeah, big picture things, obviously. We've got the situation between the U.S. and China. If you'd have told me, I feel like this is almost one of those repeat situations of trying to see what kind of maximum bearish influence we can have on this market, and the market kind of shrugging it off at the very least, or so far so good in that respect. But yeah, we ended last week with President Trump's Truth Social posts that we, would see an additional 100% tariff on China. China was a bit more reserved in their response to a certain extent. They'd already, I had said they'd come back from holiday and chose economic violence because they'd had so many things that they had rolled out with the export control additions, the port fees, some of these other things. And so we'd already seen them sort of escalate the situation. We saw the Trump response. And then over the weekend, it was relatively calm. We're hearing more about China wanting to stimulate their own economy in their own domestic consumption and some of these other things. And so that's somewhat supportive. And in the end, it feels like the market's almost kind of priced in a complete lack of China demand, or at the very most absolute minimum China demand, which in my calculations is we could get away with China really only looking to import 9 to 10 million metric tons of beans, which is substantially lower than a year ago. But at this point, it just kind of is one of those things where the entire outside market is the most loaded with fundamental developments, but the market itself is just kind of shrugging it off, yet remaining range bound.
Specifically, soybean demand, as you look at a year ago compared to a few years ago, of course, we were exporting a lot to China, but now we're not doing that. But we've also had a lot of demand in other places in the United States. Talk about that narrative of where we seeing that soybean demand and how much loss there is to not having China.
Yeah. So I think that's the thing that we tend to struggle with the most. And it's where my biggest complaint lies with the messaging from our industry groups currently, is we are ignoring the way that we used to rely on China. We used to have this major reliance. We used to see, I'll get folks in my comments still that are like 50% of our soybeans go to China. Okay. Well, first off, that never took place. Did 50% of our soybean production go to exports, or maybe even a bit more? And was China accounting for the lion's share of those? Sure. But when it comes down to it, we have seen, if you go back through even 2022, 2023, right, we were crushing 2.2 billion bushel of soybeans just 3 years ago. We are now expecting to crush 2.55, 2.6 billion bushel of soybeans in the current marketing year. And if we see a continuation of support in the biofuels industry and we see these plants coming to fruition, we've got another massive plant coming online. I don't know how we're going to supply the new plant we're going to have in Northern Ohio here and in the region, because we're already so tight on soybeans for the most part throughout the year in the Eastern Corn Belt. We're completely ignoring the fact that we have really offloaded a significant portion of our export demand needs that we used to have. We used to have to export 2.3 billion bushel of soybeans, especially with corn prices depressed in the last trade war. We didn't have corn exports. We didn't have ethanol exports like we had. And so we really, really heavily relied on the export demand that we had. In 22-23, we exported 2 billion bushel. The USDA is currently expecting us to export around 1.6, 1.7 billion. That's below the last trade war. So we're already kind of factoring in the loss in demand. What we're ignoring more than anything right now, I think, as an industry, and this is why you saw the cash market moves that you saw a week ago, what we're ignoring is the likelihood that the crop is much, much smaller than what we are currently thinking. And that also reduces that need. And that takes me back to where I said, I think China could get away with importing as little as 9 million metric ton. It'd be less than half of a year ago. A year ago was 25 million metric ton. They could get away with importing as little as 9 million, and we could see our entire balance sheet just stay unchanged.
Angie, you mentioned a smaller crop. I think we're seeing it both for soybeans and for corn.
Yep.
I don't know what the USDA thinks because we're in a government shutdown, of course, but what yield right now do you think the market is chewing on and trading?
I feel like the market is chewing on probably a 51 and a half to 52 in beans. And maybe an expectation that we do see China come into play eventually, which I think is an okay expectation to have. For corn, I feel like we're currently pricing in that 180, 181. And I think the upside risk, the upside surprise risk is pretty well gone. Like, could the USDA, would they have come out potentially in October and said 185? History says yeah. History says they're going to slow walk this thing down. They're going to wait until quarterly stocks come out in January, and then we'll see what the true yield is at that point. But right now, I would say the market is looking at a 180, 181 in line with a year ago. The risk is that it's a 175 or something of that nature. And we won't see, in my opinion, true clarity on that really, and for another 3 weeks as we work our way through harvest.
Angie, as we think then about basis, cash price, I know that's something you and Carl watch very closely. Give us a little bit of an overview for some of the markets you're watching. What are we seeing there for both corn and beans? You're
seeing a continuation of strength. It was fun today. I do a daily basis update, Western, Eastern, Corn Belt values. And the Eastern Corn Belt, the biggest thing that you're seeing right now is a relaxation of the river values because of the lower river water levels and the increase in freight rates. So you're seeing a bit of back off in there. Like you saw St. Louis back off a bit. You saw the CIF bids back off a bit. And that's more of a freight indication. It's costing more to move it. And so that's going to come out of the person who's selling the beans, if they're willing to sell them for cheaper. That'll be the fun part, is to see how long the weakness lasts. But you could see today that the Western Corn Belt bean harvest had pretty solidly wrapped up. Eagle Grove, Iowa has firmed a dime this week. Shell Rock has firmed 15 cents in the last day and a half. You got Sioux City firming up a nickel. Even Castleton, North Dakota, where all the world was ending. North Dakota, the world was over. They're 80 under. That's 40 cents better than where they started. And so when it comes down to it, messaging is massive, but basis speaks louder, right? So we thought we were going to have beans in the road or whatever, silos full of them, people putting them in their garages. That's not the case. And we can try to blame that the farmer's holding on to more soybeans or whatever. Maybe they have, 10% more on the farm, but you're not going to see everyone just completely flip and holding beans like they can't have it. It's just to me, the basis is firming. The what was put away, and what wasn't was disappointing. What came into the marketplace was disappointing versus expectations.
Well, I think a year like this too, a lot of growers can't afford to hold the beans. They got bills.
We don't have PSA loans.
Yeah,
That's
exactly.
So that's the problem that I have right now. And sorry to interrupt you, but it's one of my, immediately I'm like, exactly, because that's what we're hearing from everyone across the world is, oh, well, the farmer, like right now you're watching, like I watch the French wheat market. Like it's obviously a very important market because it's one of those markets that if Russia is not filling a world demand void, France gets the demand. It's just their wheat's very similar. And if France isn't getting it, the U.S. is getting it. It's just kind of how it tends to work. And you're seeing the French wheat spreads firm to the firmest level that they've been. You never saw basis widen as harvest came through. Like you're seeing cash prices continue to strengthen, and folks are blaming it on the lack of farmers selling. They're saying that farmers are holding wheat in bags. Like you can't hold wheat in bags. You can barely hold wheat in bins. Like wheat doesn't like to be held. It's the cat of the grain world. And so there's just this constant, like the farmer is holding, that's what's causing this market to do it. And the farmer's over here like, I'm broke. What do you mean? And so, yeah, it'll be interesting to see, especially over the next couple of months, how this all plays out, because there are going to be folks that are going to have to generate cash.
On the corn side, what things are you watching the demand, especially with E15 finally being legal in California? Do you see a lot of demand going there?
Right now, I've got a friend that does risk management for a plant in Nebraska that California tends to be one of their bigger destination markets. He's optimistic, but not overly so. I think in agriculture, I think that's everyone. Like, I'm optimistic with a nice healthy dash of cynicism. But that's basically where he does think that would be a nice increase in demand. And there's a lot of folks that are like, oh, well, that's going to benefit Brazil ethanol. Honey, they're using all of Brazil ethanol. Like in Brazil right now, they are going to 30% ethanol blend. Whatever they're producing, they're using. You are seeing a massive growth in corn ethanol demand in Brazil. We're talking 30 million metric tons, over 1 billion bushel of demand versus a year ago by the end of next year in Brazil when it comes to ethanol plants. Like they're unbridled ethanol production right now. And so, yeah, the California thing is a good thing. Anytime we can see increased demand, I'm going to celebrate.
Angie, as you think about some of the other factors, we don't yet know what this new government payment will look like, but we have gotten lots of indication from the Trump administration that another program like market facilitation payment is coming down the pipeline. When? TBD. How do you think that's going to impact grower decisions here about, do I sell, do I hold, do I wait and roll the dice to see what this new program looks like?
I don't think anyone is going, you may see some folks, I'm going to say, like you might see some folks that are going to try to hold or wait it out a little bit. But to be honest, if they have the ability to hold, they were going to hold anyway. If you've got the ability to put the crop away, the last thing the farmer is thinking about, 2 weeks post harvest is opening the bin door. Like, even if I have the best basis opportunity in the world, it takes me a lot of convincing of my growers to open the bin door, too soon post harvest. And so I think a lot of folks, I think most of the conversation is from the analyst and the originator side. It gives them the ability to be like, well, I can't buy bushels. The farmer's holding tight because of the payment. The farmer, like I said, the farmer wasn't going to be a big aggressive seller at this point unless they had to be anyway. There will be growers, there will be farmers out there that hold off on making decisions, hoping that they get something that will help improve their value there or help improve the bottom line. But for the most part, to me, I feel like the idea that we're going to get another, like the market facilitation payment style or whatever, I think that's behind the increase in corn acres that we saw. Like I think you saw an increase in certification. And I'll be waiting to see if we have an increase in harvest abandonment as we move forward because of that. But yeah, I don't think it's going to influence farmer decision making as much as folks want to say it will. But there will. I mean, every day I have someone that's calling me and saying, "Hey, you heard anything new about it? We really could use that. I hope they're looking at doing something soon." And so I'm hopeful that the administration approaches it differently. I think there's other options with lending and baking. And if you look back at the Agricultural Credit Act of 1987, I think the pathway is already there. I don't think direct payments benefit the farmer. I think they benefit the input and equipment and landlord person out there, and so I'm hoping maybe the administration's listening to that, looking at enhanced commodity loans as an option, more value out of your CCC money. Maybe some of these other things, but we'll see. But in the short term, I don't think that's having as much of an influence on selling decisions as what we want it to be.
What else are you watching that we haven't touched on yet today?
Biggest thing I'm going to be watching now is corn spreads. We saw the bean spread pop a nickel. The Nov-Jan bean spread last week did some massive heavy lifting. If you were in the Eastern Corn Belt and you saw basis firm 25 or 30 cents and the spread popped a nickel and you didn't have, it rolled out or whatever, like it's going to change your decision making. You're probably going to sell a bin of beans that might have otherwise been, corn, would have kept you from having corn in that space or whatever, if you're able to logistically facilitate that. And so I'm going to be watching, specifically how the December board behaves versus the rest of the boards. That's going to be a true indication as harvest continues, of what the real grain flow is. If you see spreads continue to firm as harvest progresses, like that is telling you that we are not putting enough grain into the pipeline to meet demand. And so, basically that's going to be, if we aren't putting enough grain in the pipeline with 186 or whatever bushel per acre crop that the USDA expects, then that's a sign that something is going on. And with as tight as every farmer's been on cash and all these other things, like we can try to argue that it's an increase in on-farm storage or whatever, but it's a sign that the crop isn't as large as we thought it would be.
Angie, really quickly before we let you go, lean hogs had a rough week last week. What are you watching there moving forward? And also any thoughts on the cattle complex as well?
Yeah, I think on the hog side of things, I think lean hogs had a rough week. I think you're going to see a spillover from what's going on with China. Obviously you're seeing a lack of demand, and that's not even trade war related. I mean, they're just looking to reduce their hog herd size. Like overall pork demand around the world is probably a bit softer than what we had anticipated or whatever. And hogs have been on a good ride following with cattle for the most part. I am a bit different, and me, I'm not going to sit here and pretend I'm a livestock expert by any means, but I will say with cattle, there's been this sort of argument of well, this is impossible and this is a new paradigm and some of these other things. The quality of meat that you get from cattle, the beef, the steaks, the ground beef, the cuts in general, the world, it's going to take a lot more to convince a person they don't want beef on their dinner table than just a little bit more expense. Honestly, and I get it. I'm speaking from a place of privilege when I say that. And I, don't get me wrong, but you can still get a nice cube steak. You can still get good ground beef for $5 or $6 a pound. You can cut it with ground pork if you want. That's a big thing at our local store. Is we have the pork and the beef mixed together now, and it's a bit cheaper and it's still just as good. I think this idea that cattle have to collapse, the life cycle is too great. The cost of entry to get into the business is too high. I think you've entered a new paradigm simply because maybe it deserves to be there. And no one wants to talk about that. It is a better product. Sorry, guys. I love pork. Bacon is my spirit animal or whatever, but and chicken's cool too, especially in tender form. But that's where I'm at with cattle. I think this idea that they have to collapse is maybe a little, of a push. Now, having said that, I'm sorry, guys, you get hedged because I'm probably bad luck. I am not the person you want rooting for your quarterback.
Well, that's a fresh perspective and certainly appreciate that. Angie, thanks for joining us today.
Thanks for having me.
Well, Delaney, it's always fun to get back to our old ways of throwing in a market segment. It's great to have Angie back on a podcast. Always great insight for our audience.
It certainly was, and happening at such a great time since we are without government insight here. But folks like Angie help keep us abreast of what's going on in the markets. But we will help keep you abreast of what's going on in the news. So be sure to tune in with us as you are wrapping up harvest this fall and getting into maybe some fall field work, Tanner.
That's right. Keep us in your ears, and we will be here again next week. But for this week, what do you say, Delaney? Should we let the listeners go?
Let's let them go.